Hello, good day. Have you heard about the phrase high risk, high return? Most people intuitively understand the principle that risk and return are linked. As the old saying goes, nothing ventured, nothing gained. In this video, we are going to learn about the capital asset pricing model. The capital asset pricing model is widely used in investment application. In this video, we are going to explore how investor and finance manager quantify the notion of risk and how they determine how much additional return is appropriate compensation for taking extra risk. It is hoped that at the end of this video, you will be able to explain the capital asset pricing model and its relationship to the security market line. In 1952, Harry Markowitz laid out the foundation of modern portfolio management. In the mid-1960s, William Sharpe, John Lindner, and Jane Mosin invented the capital asset pricing model, resulting in a Nobel Prize for Sharpe in 1990. Capital market theory builds on the portfolio theory. Capital market theory extends portfolio theory by developing a model for pricing all risky assets. The final product is the capital asset pricing model. The capital asset pricing model is well known as CAPM. It is the centerpiece of modern financial economics. The CAPM represents one of the most important advances in financial economics. The use of CAPM in corporate finance and investment is widespread. Financial websites such as Yahoo Finance, Bloomberg, Thomson Reuters Icon, FinancialTimes.com frequently provide estimates of the beta of listed companies. Its simplicity and practical appeal cause beta and CAPM to remain important tools for investors who seek to measure risk and link it to required returns in security markets. The CAPM is widely used in investment applications, for example, asset pricing, risk evaluation, and performance assessment of managed portfolios. CAPM is a model that formally links the notions of risk and return. It uses beta, the risk-free rate, and the market return to help investors define the required return on an investment. CAPM is a theory concerned with deriving the expected rate of return on risky assets. It is an elaborate attempt to provide a description of how investment returns are determined. The CAPM entails a number of important underlying assumptions. Because capital market theory builds on Markowitz's portfolio model, it requires the same assumptions, along with some additional ones. This slide shows the formula of CAPM. The required return for all assets is composed of two parts, the risk-free rate and the risk premium. Risk premium consists of market risk premium and beta. Market risk premium is the return of market minus risk-free rate. It is the extra return investor must receive for taking the average amount of risk associated with holding the market portfolio of assets. Beta refers to the sensitivity of the stock to changes in market conditions. The formula implies that the expected return on a security is linearly related to its beta. Assume you are considering security X with a beta of 1.25. The risk-free rate is 1% and the market return is 10%. Substituting this data in the CAPM equation, we get expected return of 12.25%. Investors should therefore expect or require a 12.25% return on this investment as compensation for the risk they have to assume. given the securities beta of 1.25. Let's take a look at the table below. If the beta is lower and equal to 1, the required return would be lower. In fact, in this case, the required return on the stock is the same as the expected return on the market, which is 10%. If the beta is higher at 1.5, the required return would be higher at 14.5. Clearly, the CAPM reflects the positive trade-off between risk and return. The higher the risk, as reflected by beta, the higher the risk premium, and therefore the higher the required return. We can make use of the data calculated from the previous example to show the relationship between beta and required rate of return. The relationship is linear. The graph shows a straight line. This line is called security market line. Let's have a quick quiz. What is your answer? In the context of the capital asset pricing model, the relevant risk is systematic risk. Answer is B. Systematic risk is also known as beta or non-diversifiable risk. Let's have another quick quiz. What is your answer? True or false? Answer is true. According to the formula of CAPM, beta is the determinant of required rate of return. The security market line is the graphical representation of the expected return and beta relationship. It is the graphical depiction of the CAPM. The security market line is a straight line intersecting the vertical axis at the risk-free rate. We can also describe security market line as an upward sloping line begins at risk-free rate and rises to market return when beta is 1. A risk-free asset has a beta of 0 and a risk premium of 0. The market portfolio has a beta of 1 and risk premium equal to market return minus risk-free rate. This gives us two benchmarks for an investment's expected risk premium. From the figure, you can see that the expected return on a security with a beta of 0 is equal to the risk-free rate. The expected return on a security with a beta of 1 is equal to the expected return on the market. The higher the beta, the higher the expected return. The CAPM generally relies on historical data. As a result, the beta may or may not reflect the future variability of returns. Therefore, the required return specified by the model can be viewed only as rough approximations. When we use beta, we need to make subjective adjustments to the historically determined beta to reflect our expectation of the future. We need to understand that any economic model is a simplified statement of reality. The model is simplified in order to interpret what is going on around us. The CAPM does not mean ultimate truth. It has several unsatisfactory features, and we will look at some alternative theories in my future videos, hopefully. Thank you for watching this video. This video is just a starting point in introducing CAPM. I hope you have a better understanding about the basic concept of CAPM after watching this video. In future video, I hope to discuss more in depth on other related topics of CAPM, such as beta, zero beta CAPM, and empirical tests of the CAPM. Stay tuned. See you again.